Most traders don't lose because they are wrong. They lose because they trade ideas, not evidence. Today, I will explain the real difference between hypothesis trading and structure trading, and why structure always wins in index options. What is hypothesis trade? A hypothesis trade is when you trade what you think might happen. Gap down, thinking maybe bounce. High put OI, thinking maybe support. Oversold, thinking maybe reversal. These trades are prediction based, opinion driven, and usually early. Why hypothesis trades fail? Index options decay every minute. If you enter early without confirmation, even a correct direction gives poor results. Hypothesis trades also make trades emotionally attached. They justify hope and delay exits. What is a structured trade? A structured trade is different. You don't trade what might happen, you trade what the market is already doing. Structure is visible through price, open interest, premium behavior, and futures participation. Real structure examples: when put price up with rising put OI means buyers are active. When futures price up with futures OI up means long building. But if OI rises and premium falls, that's hedging, not conviction. Then how institutions trade? Institutions don't guess. They build positions, defend strikes, hedge risk, and unwind clearly. Structure is their footprint. Hypothesis is retail imagination. Then, when hypothesis allowed, hypothesis trades are allowed only with small risk, short duration, and fast confirmation, never for holding, averaging, or hoping, especially in index options. Final verdict: hypothesis is a thought, structure is proof. In index options, proof pays, thoughts decay. Trade structure, not stories.